Imagine you're looking at your financial future. You've worked hard, saved diligently, and now it's time to make your money work for you. But with so many choices out there, stocks, bonds, real estate, commodities, it can feel overwhelming. What if there was a way to minimize risks while growing your wealth steadily over time? That's exactly what we're going to discuss today, building a diversified investment portfolio that not only protects you, but also creates consistent returns. Before we dive into this strategy, I want to invite you to hit that subscribe button. We're almost at 1,000 subscribers, and your support will help us deliver more expert content to help you build your financial future. Part 1. Understanding diversification. Let's start by defining what diversification actually means in the world of investing. At its core, diversification is the strategy of spreading your investments across different asset classes, sectors, and geographic regions to reduce risk. Instead of putting all your eggs in one basket, diversification helps ensure that if one investment doesn't perform well, the others may still generate positive returns. Think of diversification as a safety net for your investments. It works similarly to how your immune system protects you from diseases. If one part is under attack, other parts of your body step in to maintain balance. Likewise, diversification keeps your financial health in check by limiting exposure to any single investment type. Now, many of you might be thinking, why do I need to diversify? The answer is simple: risk. Every investment comes with risk, whether it's the stock market, bonds, real estate, or anything else. Diversifying your portfolio allows you to spread that risk around. This way, if one market takes a downturn, your entire portfolio isn't wiped out. Part 2. Asset classes in a diversified portfolio. Let's break down the different asset classes you can use to build a diversified portfolio. I'll go through each asset type in detail so you understand not just what they are, but why they're important for diversification. Stocks, equities. Stocks are one of the most common investment vehicles and offer high potential for returns. When you buy shares of a company, you become a partial owner of that business. Historically, stocks have provided high returns over the long term, often beating inflation and other asset types. However, they can also be volatile in the short term, and the value of individual stocks can fluctuate due to market conditions, company performance, and global events. That said, stocks are an essential part of any diversified portfolio. They offer growth potential, especially if you invest in companies that perform well over time. But it's important to be strategic about the stocks you choose, spreading your investments across sectors like technology, healthcare, finance, and energy. Bonds, fixed income securities. Bonds are loans you make to governments or corporations, and in return, they pay you interest over time. Bonds are generally less volatile than stocks and can provide a stable income stream. They are considered safer because they're less affected by market ups and downs. When interest rates rise, bond prices tend to fall, and vice versa. So, while bonds won't provide the same level of returns as stocks, they act as a stabilizer in your portfolio, helping to reduce overall risk. Bonds can also be used strategically. For example, long-term government bonds might be more stable but yield lower returns. On the other hand, corporate bonds from higher-rated companies can offer better returns, though they come with slightly higher risk. Real estate, direct and indirect. Real estate is a powerful asset class, offering both capital appreciation and income generation. Direct investment in real estate, such as buying a rental property, allows you to earn rental income and benefit from the property's appreciation over time. But let's be real. Not everyone has the capital or time to manage physical properties. That's where real estate investment trusts, REITs, come in. REITs allow you to invest in real estate without actually owning physical property. These funds pool money from investors to buy, manage, or finance real estate projects. REITs offer attractive dividends and can be an excellent way to add real estate exposure to your portfolio. Commodities. Commodities like gold, silver, oil, and agricultural products are physical goods that are traded on the open market. They are tangible assets, and historically, they perform well during inflationary periods or when stock markets are volatile. Gold, in particular, is often seen as a safe haven asset during times of economic uncertainty. If stocks are falling, gold tends to rise. So adding commodities like gold to your portfolio can serve as a hedge against inflation and market downturns. Cash and cash equivalents. Cash might seem too basic, but having liquid assets is crucial. In times of market downturns, having cash or low-risk liquid assets like money market funds or short-term government bonds allows you to stay flexible. It enables you to take advantage of investment opportunities when prices are low without needing to sell off your other investments. A good rule of thumb is to keep a certain percentage of your portfolio in cash equivalents, often between 5% and 10%, so you're not overexposed to risk. Part 3. Assessing your risk tolerance and time horizon. Building a diversified portfolio isn't just about choosing the right assets, it's also about understanding your risk tolerance and investment time horizon. These two factors will significantly influence your investment strategy. Risk tolerance is how much risk you're willing to take with your investments. Some people are comfortable with the ups and downs of the stock market and are willing to take on more risk for higher potential returns. Others might prefer a more conservative approach, focusing on stable, low-risk assets like bonds and cash. Your investment time horizon refers to how long you plan to hold your investments before needing to access the money. A longer time horizon, such as 10, 20, or 30 years, typically allows you to take on more risk since you have time to ride out market fluctuations. If you're planning for retirement, for example, you might invest more in stocks and real estate. But if you need the money in the next 5 years for a major purchase, you may want to focus on more stable assets like bonds. Part 4. The importance of rebalancing. Rebalancing is a critical, often overlooked part of building and maintaining a diversified portfolio. As market conditions change, the value of different assets in your portfolio will fluctuate. Over time, this can skew your asset allocation and lead to unintended risk exposure. For example, if stocks have been performing well and now make up 70% of your portfolio when your target was 60%, you may want to sell off some of your stocks and buy more bonds or other asset types to return to your original allocation. Rebalancing helps ensure that your portfolio stays aligned with your investment goals, risk tolerance, and time horizon. It's important to review your portfolio at least once a year to ensure that you're not too heavily invested in one asset class. Part 5. Index funds and ETFs. Easy diversification. For many investors, especially beginners, index funds and ETFs, exchange-traded funds, are an ideal way to get diversified exposure to the markets without the hassle of picking individual stocks or managing a portfolio of assets. Index funds track major stock indices such as the S&P 500 or the NASDAQ 100. When you invest in an index fund, you're effectively buying a small slice of every company in that index, providing instant diversification. These funds are low cost and perfect for passive investors who want exposure to the overall market without trying to pick the next big stock. ETFs, like index funds, offer diversified exposure but trade like stocks on an exchange. ETFs allow you to invest in a specific sector, industry, or asset class, such as technology, healthcare, or international markets, while still achieving diversification within that category. Part 6. Avoiding common pitfalls. As with any investment strategy, there are potential pitfalls to watch out for. Here are a few common mistakes people make when building a diversified portfolio. Over-diversification. Too much diversification can dilute returns. You don't want to spread your investments so thin that you miss out on the growth potential of any one asset class. Chasing past performance. Just because an asset performed well last year doesn't mean it will continue to do so. Always evaluate investments based on their fundamentals, not just past performance. Timing the market. Trying to buy low and sell high can be tempting, but it's incredibly difficult to do consistently. Focus on long-term goals and avoid making emotional decisions based on short-term market movements. Neglecting to rebalance. As we discussed earlier, regular rebalancing is essential for maintaining a well-diversified portfolio. Failure to do so can lead to unwanted risk exposure. Building long-term wealth. In conclusion, building a diversified portfolio isn't about finding a magic formula or making risky bets. It's about developing a strategy that works for you based on your goals, risk tolerance, and time horizon. By carefully choosing a mix of asset classes, stocks, bonds, real estate, commodities, and cash, you can protect your portfolio from market volatility while also positioning yourself for long-term growth. Remember, the key is consistency and patience. Stay focused on your goals, keep your emotions in check, and let time do its work. Diversification will protect you in the short term while helping you grow wealth steadily over the long term. If you found this content valuable, don't forget to subscribe and help us reach 1,000 subscribers. Let's keep building our wealth together. Thanks for watching, and I'll see you in the next video.